Friday traders. My name is Neal Patharkar, the founder of Friday University, and I'm going to go over day trading ticker ERYP and the gap up short strategy that had today on its day trading session. When we look to a gap up short, that means the stock had a higher open than its previous closing price. As we can see from this chart on the 1 year, 1 day time frame on my Thinkorswim platform, the stock closed around $4 a share and opened around $8.50. So that creates a gap in the chart where you can see that overnight it has something to fill. And the reason why it's filling below or has a big red day today is because the stock normally was getting pushed down, not a lot of buying. So when there's an opportunity for more people to short or want the stock to go down at a higher price when they know it's going to probably result in a lower price, they got an opportunity. And that opportunity took place today. Real quick, I couldn't execute my trade because I didn't reserve the shares to short. A lot of times you have to pay a commission, and I wasn't willing to pay the 50 cents a share. Now that I've seen this play out, would it have been worth it? Of course, but let's just go into it. I noted it. Go in and get the shares to short. So despite this pump from 4 to 22, whatever that was, the real action was around after that. So that's where it kind of hit $10 and found that as a key resistance. And then today it was like around 6 to start the pre-market action. And as we can see, the two lines that I just marked up are all we need, because 6 ended up being the support, 10 the resistance. The simple thing was going in there open, it was trying to spike back to that resistance, and it did get near it around 9.5, but immediately pulled back, and the resistance here, 8.75, that was prevailing from around 8 a.m. all the way to 9:30. That broke once, but was a fake out, which means the stock went above, couldn't hold that level, couldn't find this resistance as support to continue the upward move. As a result, in a 5-minute time frame, went all the way down to 7.75 below the support. Now that as the resistance, signaling the bears are in control, but this is an ideal entry, and everything plays out for the shorts in a day trading opportunity. So it continued to decrease all the way back to the support. So I'm trying to learn patience, opportunity, all these things come into play, but with a bleeding gapper that has a bearish chart history and a huge gap up of 250%, this is an ideal setup. So let's go to the position size calculator. If you can get in at that 8.5, target price was the support 6.2, and maybe stop loss is around 10. So we can lower the stop loss to 9.8 because near the resistance, and 9.8 sounds a little bit better. It's still an even number. So let's see. You take a 150 share position, which in my case would have only been on a $10,000 account size. In theory, that would have only been a $75 commission, and with the 200 risk per trade, so you would have been risking $275 to in turn make $275 because you got to minus the 375 from the 350. So in all, it was a 1-to-1 risk to return. So not bad. Speaking of the fact that it happened and a win would have been better than a loss, but at the end of the day, it's a trade that I gotta take. And here is 9.8 on the chart, a little bit higher than what it ended up hitting, even if you got in at the worst possible time. But we got in at, let's say, in theory, 8.5. I didn't send it, but we can look at this stock and pattern for potential penny stock plays in the future, and 6.2 is around the current price. So even though you're projected to make $150 more per trade on a win than a loss, the $75 commission or fee to reserve the shares to short would have taken an effect and made it practically 1-to-1. So that's just something to consider. Just reviewing that. All in all, happy Friday, everyone. I hope that there were some lessons learned from ERYP. And until next time,